Good afternoon, investors. Carlos Russo here with World Cup Investments. Today is Wednesday, February 9th, 2010. Inflation. Inflation has been on a lot of people's mind lately. You know, we as a government, as the United States has printed a lot of money, and that's going to cause potentially some inflation to rear its ugly head. The CPI number, or the Consumer Price Index, is not a accurate gauge of inflation. In fact, back in the 1970s, the government decided that housing is just too volatile and we shouldn't include housing in the CPI number. So the CPI number is really not our gauge on inflation, it's just our gauge on consumer prices. Let's take a look back at the bubble that occurred in 2004 and 2005 in the housing market. What caused the bubble? Well, expansion of the money supply caused the housing bubble, and the expansion of the money supply came in the form of extremely low interest rates. All of a sudden we had 40-year lows for interest rates, and we had extremely loose lending standards. In fact, lending standards were so loose that some people had the perception that it was cheaper to buy a house than to rent a house, because they were able to do things like get a no-doc loan, no credit check, pay a slightly higher interest rate, but no money down, right? And if they went to a landlord, the landlord would say, hey, I'm going to do a credit check, there's an application fee, and you need to pay security deposit as well as first month's rent. Right? If they bought a house, they could move in, maybe pay a little bit of closing costs, and they wouldn't have to make a payment for a month or more if they decided not to make any payments. So, of course, the other thing that was driving the buyer back during the bubble was that values were rising, right? And so there was no way they were going to lose. They were going to make money, right? So it was foolish to rent, foolish, right? Well, little do we know that the bubble was just about to explode, and most people, of course, didn't see this coming. And so that expansion of the money supply back then caused a rise in that particular asset class, which was housing. And now what we have is just a printing press, right? We're printing lots of money, and money supply is coming on in a slightly different form. We still have very low interest rates. In fact, they're lower now than they were back then. The only difference being that the bubble has already burst in terms of real estate values. But this money supply situation that we have now is worse, far worse than it was back then. And so it might cause a significant rise in values across the board. I'm talking commodities, housing, everything, So if you want to protect yourself as an investor from inflation, one of the best places to be is real estate, because everybody needs real estate. You got to live somewhere, right? And home builders aren't building 1 million homes a year right now. They're building 350,000 homes a year because they know better, right? They've learned their lessons, and they're lucky not to have gone bankrupt. Part of the bailout money, again, money supply, went to home builders and stabilizing that particular industry. So, one other thing to look at, I think, that's very interesting with respect to investing in real estate is the comparison of real estate values to the value of gold and the value of silver. I'm going to put up a chart right here, actually a link to a chart on the internet that shows the value, average value of home prices, or median value of home prices, with regards to gold values and with regards to silver values, and you'll see a significant amount of volatility there. And you'll see right at the height of the bubble in 2004 and 2005 that the average home price was priced in gold and priced in silver far higher than it had ever been before. That was a great clue for somebody looking at that chart to say, hey, time to get out. Time to get out of real estate and move into a different asset class. Well, now it's the exact opposite, because home values have come down significantly, and of course commodities have risen in value. Gold and silver are both trading near all-time highs, and the pressure for gold and silver to move up is much stronger than the pressure for them to move down, thanks to money supply once more. So, when you look at, say, a $60,000 home in Phoenix or another part of the nation, and you take that into account with respect to gold and silver, you'll find that, that means that you would have to sell, 55 ounces of gold to buy this house, and it may not be the median price value, it's below that, but that's still very cheap. Historically, when we hit the low of housing priced in gold, I think it was back in the 70s, that number was about 100 ounces of gold. And the reason why now our median prices are so high is because we have an extreme number of homes that are overpriced, that are very expensive houses, and so that skews the average. It brings the average up. So with that, I'll leave you today. Thanks for joining me, and I'll see you next week.